Welcome to the Deep Dive. We're here to break down the source material and give you the insights you need. Today, we're diving into Legacy Education, Inc. That's ticker LGCY on the NYSE American. It's a fast-growing micro-cap in career education. Our reference date is September 21st, 2025, and the stock's at $12.86. So our mission today is to unpack these sources, which show two, well, pretty conflicting pictures. Can this growth story really overcome the huge regulatory risks hanging over it?
Yeah, that conflict is exactly what makes this one so interesting. The sources lay out this stark contradiction. I mean, on one hand, you look at an intrinsic valuation model, and it suggests the stock might be undervalued by, get this, over 180%. That implies a potential fair value around $37.23. Just massive potential upside.
Yeah.
Right, based on the fundamentals we see.
Wow, okay.
But this is but the entire business model, everything they do, it relies on federal funding decisions. It's like operating under, a legislative overhang, as some put it. So we're looking at this potential for spectacular returns, but it's constantly shadowed by this, well, existential political risk.
That definitely sets the stage. Okay, let's start unpacking this. Let's begin with the company itself. #tag chapter 1, business analysis, the engine of LGCY's growth. So Legacy Education, it's a for-profit provider of post-secondary education, but they're not like traditional colleges. Their whole focus is career training, think allied health, veterinary tech, business program.
Exactly. And their revenue is pretty much all from student tuition and fees, which they recognize, as the student goes through the program. Their big selling point, their value proposition, it's really tuned for today's market. It's accessible, it's relatively affordable, and maybe most importantly, it's fast, accelerated.
Fast is key, right?
Yeah, some programs are as quick as 9 months. They offer a direct path to a job. And that really appeals to students who aren't maybe looking for that traditional 4-year degree. Maybe they're wary of the debt, the time commitment.
And they're building up scale. How are they doing that?
Through acquisitions, mostly. A roll-up strategy. They own 4 accredited schools right now, all in California. Places like High Desert Medical College, Central Coast College.
And that recent one was important, wasn't it?
Very important. The Contra Costa Medical Career College, CCMCC. They bought that in December 2024 for about $7.5 million.
Okay.
And that single deal boosted their total student count to over 3,200. That's nearly a 50% jump year over year. So it really shows that acquisition playbook can work.
So it's still small overall, a micro cap, $159 million market cap?
Right, tiny compared to the whole U.S. post-secondary market, which is, over $1 trillion. But they seem positioned for some real structural tailwinds.
Like the healthcare worker shortage.
Exactly like that.
Yeah.
There's this huge, persistent need for healthcare workers in the U.S., and LGCY is training exactly those kinds of people. Allied health is their sweet spot.
And just in California, you said?
Yep, purely focused on California right now. That gives them a kind of defensible niche. And interestingly, the CEO is also the president of the California Association of Private Post-Secondary Schools, CAPPS. So, deep connections there at the state level.
Okay, and we need to make a clarification here based on the sources. This Legacy Education, LGCY, is not the same as Legacy Education Alliance, Inc., ticker LEAI. That one's an OTC stock, apparently financially distressed, totally different company.
Crucial distinction, absolutely. Now let's talk about the regulatory environment, because it's everything here. It's both their protection and their biggest risk.
How so?
Well, the whole business critically depends, on being eligible for Title IV federal student aid programs. Think federal student loans, Pell Grants. Without that, the model doesn't work for most students.
Okay.
But getting that eligibility, getting institutional accreditation from bodies like ACCET or ABHES, and then getting the Title IV certification from the Department of Education is a long, complicated, expensive process.
So that's the barrier to entry.
That's the main barrier, yeah. It keeps out weaker players. It's LGCY's competitive advantage, their moat, and they do seem to perform well within that system. The sources mentioned a graduate placement rate of over 75%.
And an 83% pass rate for the NCLEX nursing exam, which is pretty strong.
Exactly. So they're meeting the requirements and delivering outcomes, which is key for maintaining that accreditation and funding.
#tag chapter 2, management evaluation, stewards of capital. Okay, let's talk about the people running this operation. How effective is the leadership team?
Well, you've got the founder and CEO, Leanne Roman. She has over 15 years of experience in this sector. And the CFO, Brandon Pope, he brings specific expertise in the complex regulatory and financial side from previous roles at other for-profit education companies. That's pretty relevant experience.
Sounds like they know the landscape.
Seems so. And on governance, they've recently added 2 new independent directors, which is generally seen as a positive step for oversight.
And their strategy, what's the plan for using capital?
It's all about high growth, purely focused on growth, really. 2 main ways they do it. First is organic investment, meaning developing new programs that are in demand. Like, they recently got accreditation for a Bachelor of Science in Nursing, a BSN program. That's a big deal.
Okay, and the second way.
That's the M&A roll-up strategy we talked about. Using their public market capital, which they got from their IPO back in September 2024, to buy up smaller colleges.
Like this CCMCC deal.
Exactly like CCMCC. That deal proved the playbook works. It translated almost immediately into that 50% revenue growth.
And are they returning capital to shareholders, dividends, buybacks?
No, none of that, which is actually appropriate for a company at this stage. They're reinvesting everything back into the business to fuel that growth.
Makes sense. So how well are they actually using that invested capital? Is there a way to measure that?
There is. We look at return on invested capital, or ROIC. The sources calculate a normalized ROIC for LGCY of 15.81%.
Okay, 15.81%. Is that good?
That's considered excellent, actually. It's strong evidence that management isn't just spending money, they're allocating capital profitably. They're generating returns significantly higher than their likely cost of capital. It shows the core business is efficient, and the growth strategy is creating real value, quantitatively speaking.
#tag chapter 3, financial analysis, the story and the numbers.
Got it. So that efficient strategy, how does it look on the financial statements? The numbers must show something interesting.
They show acceleration, definitely. Now, because the IPO was fairly recent, we don't have deep 5-year data, but the trend is really clear. Trailing 12-month revenue growth was almost 38%. But the most recent quarter, Q3 2025, year-over-year revenue growth was 50.7%.
Wow, that CCMCC effect again.
Directly attributable to that acquisition. Yeah, it kicked in immediately. And it's not just top-line growth. Net income for fiscal year 2024 jumped almost 92% to over $5 million.
So they're profitable too. What about margins?
Margins look healthy. Gross margin is around 43.5%, and the net profit margin is over 12%. That suggests they have some pricing power, likely because of the demand for those specific healthcare certifications, and they're running things efficiently.
And the balance sheet.
Yeah.
Is the growth fueled by lots of debt? Actually, no. The balance sheet looks pretty strong. Debt to equity is quite manageable, around 45–46%. And their short-term liquidity is excellent. The current ratio is cited as 2.65x. That means they have, $2.65 in current assets for every dollar of current liabilities. Right. Very healthy cushion there.
Okay.
And importantly, the operations are described as capital light, low capital expenditure needs. That suggests most of the revenue growth should theoretically convert into free cash flow.
And that cash flow fuels
more acquisitions, presumably. That's the model. More cash to keep the M&A engine running.
Okay, let's talk valuation then. How does the market price this growth?
Well, if you look at a simple price to earnings or PE ratio, LGCY's is around 21.9x. That's a little bit higher than some peers mentioned, like LRN or ATGE. But you could argue it's justified because LGCY's growth rate is significantly higher right now.
Right, but then there's that other valuation number, the intrinsic one.
Ah, yes, the discounted cash flow, or DCF valuation. This is where it gets potentially exciting, but also highly speculative. The concept is you estimate all the future cash flows the company might generate and discount them back to their present value.
And that model comes up with
an estimated fair value of $37.23 per share. Compared to the current price, around $12.86. That's that potential 180% plus upside we mentioned at the start.
Okay, that's the number that grabs headlines. But there has to be a catch, right? What does that $37 number assume?
A huge assumption. It relies on LGCY being able to sustain a very aggressive earnings growth rate. The sources cite 19.93% per year consistently over the long term.
Nearly 20% earnings growth every year. That sounds ambitious.
It's very ambitious. It basically means management has to keep executing flawlessly. They need to keep finding good acquisition targets like CCMCC, integrate them smoothly, and continue developing successful new organic programs like that BSN.
All while navigating the regulatory minefield.
Exactly. If the M&A pipeline slows down, or if they stumble on an integration, or if a new regulation hits them unexpectedly, that 19.93% growth rate suddenly looks very, very difficult to achieve. And the DCF value tumbles.
So high potential reward, but resting on some demanding assumptions and execution.
Precisely.
#tag chapter 4, market sentiment. The market's perception. All right, we've got the company fundamentals, the potential upside, the risks tied to execution. Let's zoom out a bit. How is the wider market viewing LGCY right now? What are analysts saying?
It's actually quite interesting, maybe even a bit confusing. The consensus rating among the analysts who cover the stock is a strong buy.
Okay, that sounds positive, aligning with the growth story.
Yes, but here's the contradiction we flagged earlier. Despite that strong buy, the average one-year analyst price target is only $11.07.
Wait, $11.07. That's lower than the current price of $12.86. It's about 13% below where it's trading now.
Exactly. It's a very unusual situation. Why recommend a strong buy on a stock whose price target suggests it's going to fall over the next year?
Yeah, what's the explanation for that disconnect?
Well, the sources suggest a couple of possibilities. One is simply that the analysts' models might be lagging. Perhaps they haven't fully updated their forecasts and targets to reflect the huge Q3 revenue beat driven by CCMCC and the subsequent stock price run-up. They might be waiting for more data.
Okay, so maybe the targets will catch up later.
Possibly.
Mm.
Or another view is that analysts might see the long-term story positively, hence the strong buy, but believe the stock has gotten a bit ahead of itself in the short term, maybe some technical overextension after the recent rally. So they expect a pullback before it resumes its upward trend.
Interesting. What about other market signals, technicals? Short interest.
Technically, the stock looks strong. It's trading well above its 50-day and 200-day moving averages, which usually signals a solid uptrend. Bar chart even issued a 100% buy signal based on technicals.
And are people betting against it? Short sellers.
Very few, it seems. Short interest is extremely low, cited at just 0.69% of the float. That means there isn't significant institutional money betting that the stock price will fall. That lack of bearishness is generally a positive sign.
And the media tone.
Overwhelmingly positive, according to the sources, focusing on the record growth, the strategic milestones like the BSN program, and the strength in governance. So market sentiment seems positive overall, despite that weird analyst price target situation.
Hashtag tag chapter 5. Ownership structure. Who owns LGCY? Okay, let's look inside the company. Who actually owns the stock? Does management have skin in the game?
They definitely do. Insider ownership is substantial at 22.5% of the company. That's quite high and generally seen as a strong positive.
Why is that so important?
It aligns management's interests directly with shareholders. If the stock does well, they benefit significantly. CEO Leanne Roman herself holds a 7.21% stake, which the sources value at over $11 million. That suggests she's heavily invested in the company's success. It reduces what's called agency risk.
Makes sense. And net insider activity. Buying or selling.
Over the last year, insiders have been net buyers, not sellers. Another positive signal.
What about big institutions? Are pension funds, mutual funds buying in?
Yes, institutional ownership is around 33.1%. And importantly, the number of institutions holding the stock has been increasing. That suggests growing credibility among professional investors, people who presumably do deep research, especially on those regulatory risks. Names like Hollow's Integrated Wealth and Royce & Associates are mentioned as top holders.
So growing institutional confidence. Any downsides to the ownership structure?
Just one potential flag: concentration risk. The top 25 shareholders own nearly 64% of the company. Meaning a large chunk of the stock is held by a relatively small number of entities. While this ensures a strong vested interest, it also means if one or two large holders decide to sell a big block of shares, it could cause significant volatility in the stock price, more so than if ownership were more widely dispersed.
Got it. So strong alignment, growing credibility, but potentially higher volatility due to concentration.
That sums it up well.
Hashtag tag chapter 6, risk assessment. A 360-degree view. All right, we've touched on this throughout, but let's really focus on the risks now. Because as much potential upside as there seems to be, the risks here are not trivial.
Not at all. And the biggest one, the single greatest threat overshadowing everything, is regulatory risk. It's the elephant in the room for the entire for-profit education sector.
Specifically related to that Title IV funding.
Exactly. The business model is fundamentally vulnerable to any negative changes in federal policy regarding how that student aid is distributed or what rules schools need to follow to access it.
Can we break down the specific regulations mentioned as key risks?
Sure. Two big ones are consistently highlighted: the 90-10 rule and the gainful employment rule.
Okay, what's the 90-10 rule?
This rule mandates that for-profit colleges, like LGCY schools, cannot receive more than 90% of their revenue from federal student aid programs under Title IV. At least 10% must come from other sources like private loans, institutional scholarships, cash payments, maybe state grants, etc.
And if they fail that, if they get, say, 91% from Title IV,
They lose eligibility for all Title IV funding. It's an existential cliff. Even small changes by regulators in how revenue sources are counted for this calculation could suddenly push a school over the edge. It's a constant compliance pressure point.
wow. Okay, and gainful employment.
Gainful employment rules are designed to measure whether graduates from career education programs earn enough money after graduation to actually repay their student loan debt. They look at debt-to-earnings ratios. If a specific program at one of LGCY's schools consistently produces graduates with poor debt-to-earnings outcomes, that program could lose its Title IV eligibility. Too many failing programs, and the whole institution could be at risk.
So both are direct threats tied to federal policy, which can change depending on the political climate.
Precisely. It's a risk entirely outside of management's direct control, really.
What about other weaknesses beyond the big federal risk?
Well, there's the geographic concentration we mentioned. Being solely in California makes them vulnerable to state-specific economic issues or changes in California regulations or licensing requirements. A downturn just in that state would hit them much harder than a more diversified company.
And the growth strategy itself carries risk, right?
Absolutely. Integration risk. The whole strategy hinges on successfully finding, buying, and integrating more colleges, like CCMCC. Future deals might not go as smoothly, or they might overpay, or the cultures might clash. Each acquisition adds execution risk.
Plus, there's the reputational issue.
Yeah, reputational contagion. The whole for-profit education sector can sometimes get painted with the same negative brush. Even if LGCY is doing everything right, a scandal at another unrelated for-profit school could create negative sentiment that hurts LGCY's stock or makes regulators scrutinize them more closely.
It's fascinating, isn't it? That regulatory complexity is both their protective moat and the biggest sword hanging over their head.
It's the core paradox of investing in this space. High barriers to entry because of regulation, but also existential threat because of that same regulation.
Hashtag tag tag chapter 7 conclusion. Okay, let's try to synthesize all of this. If we look at the bull case, the reasons to be optimistic about LGCY, what are the key points?
Strong market position, definitely. They're tapping right into that critical healthcare worker shortage with focused programs. They have a proven growth engine that M&A strategy is working, combined with organic program development like the BSN.
And the financials look solid.
Very solid. Strong margins, manageable debt, excellent liquidity, and that really impressive 15.81% ROIC showing efficient capital use. Plus, you have high insider ownership, so management's interests are aligned with yours.
Right. Now, the bear case, the reasons for caution.
It really boils down to one major factor and its consequences: the overwhelming dependence on Title IV federal funding. That makes the company incredibly vulnerable to shifts in political winds and regulatory changes. 2010, gainful employment.
Plus the California concentration.
Yes, the geographic risk. And maybe that weird analysts disconnect the strong buy rating, but the below market price target warrants some caution too. It suggests some uncertainty out there.
So wrapping it up, LGCY looks like a genuinely high-growth, profitable company. They're executing a smart consolidation play in a fragmented but essential market career education, especially healthcare.
And that potential intrinsic value the DCF model throws out, around $37, suggests there could be massive upside if they keep executing and the regulatory environment stays favorable or at least stable.
But investors absolutely must weigh that potential against the very real, unpredictable, and potentially catastrophic risk from federal regulation changes.
Exactly. At the end of the day, your decision on LGCY likely comes down to your personal tolerance for that specific type of political and regulatory uncertainty. Can you stomach the chance that a policy shift could derail this growth story? That's the key question.
Thank you for joining us for this deep dive into legacy education. We really hope unpacking these sources helps you figure out your next step. And here's a final thought to chew on. Legacy education success with these fast, career-focused programs points to maybe a bigger trend, doesn't it? A kind of student rebellion against the time and cost of traditional four-year degrees. So the question is, will traditional universities eventually be forced to adapt and offer similar rapid, focused programs? Or will LGCY's niche stay protected precisely because the established players are too slow to change? Something to think about. Hey, if you found this valuable, please like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority access to deep dives on tickers they request. We're planning to cover all the S&P 500 stocks over the next few months, and members get first dibs. Want a one-off deep dive on a specific stock? Just drop us a super thanks.
And just a reminder, This analysis was generated by an AI system. It's meant for educational purposes only and should definitely not be taken as financial advice. Always do your own research, or better yet, talk to a qualified financial advisor before making any investment decisions.